This is the Asia Trade. I'm Shery in Tokyo.
And I'm Avril Hong in Singapore. The top stories this hour. A weak Wall Street lead-in for Asia as Nvidia leads a big tech sell-off. The RBNZ expected to resume rate cuts today, taking the cash rate to a 3-year low. Intel shares extend gains as the Trump administration weighs taking a stake and SoftBank buys in, giving the troubled U.S. chipmaker access to billions in fresh capital. And European leaders said to offer troops as a Ukraine security package takes shape ahead of a potential Putin Zelenskiy meeting.
Take a look at how we're setting up for the Asia markets. We are seeing Chicago Nikkei futures holding steady at the moment, but this, of course, after Japanese stocks already saw pressure in the previous session coming down from record highs. We'll be watching those JGB today because we had that 20-year bond auction seeing weaker than average demand. We were watching the Japanese yen still holding at that 147 level against the U.S. dollar. Pretty tight range of trading. Of course, lots of big decisions this week, including today. We have the RBNZ expected to cut rates. We have the Bank of Indonesia central bank also expected to hold pat, given that they might probably want to support the rupiah. We have China's commercial banks also coming out with loan prime rates today, so do watch out for the offshore yuan at that 718 level. But it's really about central banks this week, right? Take a look at how U.S. futures are setting up ahead of Jackson Hole. We do have Chair Powell, of course, speaking this week, and really those expectations being cemented around that 25 basis point rate cut from the Federal Reserve. Right now, not doing much in the future side of things, but take a look at those tech names that we've been watching because it's really been about that broad sell-off. Of course, we continue to see valuations pretty stretched. We are talking about the Nasdaq 100 trading at 27 times expected profit in the next 12 months. And the likes of Nvidia, for example, seeing its biggest plunge since April. Let's discuss all of this and bring in Garfield Reynolds, who leads our Markets Live Asia coverage. Garf, are we going to see a sustained rotation out of tech now?
Well, it's very hard to say because the move overnight didn't have any obvious triggers. I mean, in fact, it looks to some extent like a bit of nerves before a couple of key events. You know, one is the Jackson Hole speech and the potential that that will see Chairman Powell push back against the idea of rapid rate cuts, and which could also, of course, set off some turmoil with the White House. And then next week, we've got Nvidia earnings, and that's absolutely key for the tech space. There's been some growing concerns that the AI boom could start to run out of momentum. Not that it would go away, but that a lot of the low-hanging fruit, so to speak, in the AI space have already been picked. So this, looks a lot like there are some investors who've decided might be a good time to reduce their exposure heading into those events, given the risks.
Garf, does this include for Asia tech, or do you think they can sort of do their own thing?
Oh, no, Asia tech is very much exposed, because, I mean, the big players in Asia tech, most of those are very tightly keyed into either Nvidia itself or alternatively to some of the other main US big names like Apple, for example. So it's hard to see Asia tech doing particularly well after Nvidia's decline. One potential bright spot could be China because they have their own local drivers. We haven't heard much about DeepSeek lately, but China is pushing to develop its own somewhat independent from the US scene, champions in this space. So China might show a bit of resilience. The rest of Asian tech looks unlikely to. 3.5% declines for Nvidia and the declines therefore at AMD. And then, of course, the Taiwan Semiconductor ADRs. All of those signal a pretty dim outlook for Asian shares in general today, and especially Asian tech.
And on Jackson Hole week, of course, the focus very much on what's happening in the bond space as well. We have seen the 2-year yields really come down significantly this month on expectations of that 25 basis point rate cut from the Fed in September. But now there are even bets that it could be bigger than that, 50 basis point cut.
Well, 50 basis points seems very unlikely unless we get a really bad jobs report, at the beginning of next month. We had a shockingly poor one last time around with those infamous revisions. And that's what sent two-year yields down, and that's why you've got a very strong constituency in the market expecting that 25 basis point cut. 50 basis point cut seems very unlikely, possibly even with some poor jobs data, because the Fed does have a dual mandate, and the inflation part of that mandate looks very tricky as well. The PPI in particular showing that inflation pressures have come back, and that they're not just about tariffs. The services side of things is at least as concerning as the signs that there is some trickle through from tariffs to inflation. So in that situation, in a lot of ways, the Fed would be in wait and see mode, perhaps right up to the meeting. And we have the complicating factor now that President Trump's calls for major rate cuts are going to have an impact. Trump's calls for rate cuts have already arguably had an impact when you look at the way that two of the Fed governors dissented last time round, called for a rate cut, and those two seem to be far more in line with the way President Trump is looking at things. And even if they're trying to justify it on the basis of a weak economy, President Trump's argument is that the economy is doing great, but it would do better if there were rate cuts, and in particular, then the government wouldn't have to spend so much money on paying interest on its debt.
Yeah, Gav, to your point, Trump posting on social media again about so-called too late Powell, that he's hurting the housing industry. Gav, thank you so much for running us through all this. Garfield Reynolds, who leads our Markets Live Asia coverage. Now, we are watching for how these recalibration of Fed rate cuts could affect tech. And one of the tech names that, interestingly, bucked the sell-off on Wall Street was Intel. Shares of the struggling chip maker are up nearly 30% this month so far. Let's get more with our Asia tech correspondent, Annabelle Drollers in Hong Kong. Belle, it looks like these Intel bulls, they're finally being rewarded for their patience.
Yeah, that's right. As you said, we've seen a really big surge just in the stock alone over the past few weeks. And the catalyst for that, we were kind of talking about them yesterday, but just to recap, you've got those reports that the US government is looking at taking a 10% equity stake in the business. And then as well, adding to that, you had SoftBank announcing that $2 billion investment into the company as well. So these are, again, these positive moves. You saw that rally overnight, but here you can see just in August alone, you're looking at gains of around 30%. The surge, though, means that we're trading at 53 times profits projected over the next 12 months. And that is the highest going back to 2002, which means that we're in dot-com territory as well. That is actually a cause for concern because, of course, a lot of people will talk to you about the issues that Intel as a company faces. It's really just at the outset here of what could be a multi-year restructuring effort. The outlook as well looks very challenged. And you also saw that because we had earnings at the end of July, and that was another disappointing release for the company. What's interesting as well is when you speak with analysts, only 8 of them would have a buy rating on the stock right now. 80% of them have the equivalent of a neutral rating. So, yes, it has had a big surge, but there are some causes for concern off the back of that as well.
Yeah, and really concerns about the broader tech sector supercharged by that frenzy over artificial intelligence, right? Meta seems to be restructuring their AI division. What do we know?
Yeah, this is an interesting one as well. Actually, it was first reported by The Information. We've had more details on that overnight. So we know, of course, Meta is a company that's been spending billions of dollars on its efforts to build out so-called artificial superintelligence. This is under the leadership of someone who's just recently joined the business formally. That's Alexander Wang. He is the chief AI officer for the company, and he actually just sent out a memo overnight talking about how the company is going to be changing its AI business structure. They're going to be splitting into 4 4 new teams, or 4 distinct teams that are going to be basically looking at a few different tasks. The first one is going to be overseeing Meta's large language models. The second one is going to be an internal AI research lab that's actually existed within the company for more than a decade, but it will be focused on longer-term projects. The third one will be taking those projects and putting them into consumer products. And then the fourth one as well is going to be focused on the infrastructure, the expensive infrastructure that's needed to support Meta's AI ambitions. So no layoffs actually were part of this reorganization. That's according to people that are familiar with the matter. But still, as we said, it's an interesting move given how much Meta has been spending to try and acquire the best talent in the market.
Bell, we'll also be getting an update of sorts from Baidu's AI efforts when it reports. What are we expecting?
Yeah, well, Baidu, as we know, is a company that has quite a different outlook when it comes to AI. They were an early leader in the AI landscape in China in particular. They have their Ernie bot, of course. It was one of the first chat bots, essentially, on the market. But since then, it's really had to cede a lot of ground. And you've seen that really reflected as well in quite a challenged sort of share price outlook. But our Bloomberg intelligence team is saying that essentially the prospects still look quite tenuous. They're expecting another set of weaker results for the business. That's going to be further undermining the growth prospects. But they're also seeing sort of lack of traction both on the top and the bottom line, and so they're saying that essentially the AI prospects do remain overhyped. What will be interesting as well, of course, is to get an update on the robo-taxis, given that Apollo Go, which is its own robo-taxi arm, is continuing to sort of ramp up its international expansion. So just two of the key things we're watching out for. Ad revenue as well will be another focus for us, given that there's those concerns. As you build out your AI efforts, are you also cannibalizing the initial search engine business, the sort of bread and butter business for the company as well?
Belle, thank you so much. Our tech reporter Annabelle Jolas. Coming up on the Asia trade as well, Bernstein tells us why they remain bullish on Asian equities through the rest of 2025. Plus, analysis on the Ukraine peace process with the US-German Marshall Fund. Much more ahead. This is Bloomberg.
A package of security guarantees for Ukraine will take shape as soon as this week, with European leaders offering troops as part of a potential peace deal. Ukrainian allies are hoping to strengthen Kyiv's position ahead of a potential meeting between Presidents Vladimir Putin and Volodymyr Zelenskiy. Let's bring in Bloomberg senior editor Derek Wallback. Derek, so do we have any idea right now what this package could look like?
Well, Shery, it's something that's very much still taking place. So let's start there. This is not a situation where we've got a lot of final details. This is something where European allies are racing to try and find a package that can work for all of them, that can bring in the United States as a key partner. And they're trying to do it in a way where it's an initiative of their own. Let's say it that way. The view among European allies of Ukraine is that Vladimir Putin does not necessarily get a veto over the idea of a security force that might get left in Ukraine to sort of bolster Ukraine in any kind of final deal. And so they're using the fact that Donald Trump spoke highly of this idea at the White House in public on the record to say, right, let's go, let's put this together, let's figure out the logistical details of what this might look like and get it going right now. The idea being perhaps if this goes through, that this is a credible, defensible position that can help Ukraine stay solvent as a geographic force in any peace deal, should there be complications arising. But at the same point, if Vladimir Putin is not serious about peace, there is some argument that maybe this would be a trip hazard that would expose that. And that is something that we've heard suggested as well. The key crux of this is some form of actual physical, tangible support, what that looks like, whose boots are on the ground. There was a suggestion that American boots on the ground would not be in place here, but it would be European ones. So that's an important thing. And then the other important thing is this idea of an Article 5 style trigger mechanism in terms of if Ukraine is attacked again, what does that trigger and how does that process go forward? It's modeled on the idea of NATO's Article 5, which says if one is attacked, all are attacked. And so that's a really important kind of thing to figure out logistically. But the move is on to try and do this quickly.
Right. So those are the contours of a potential Ukraine security arrangement. But we're also hearing from Trump how he wants Zelensky and Putin to meet. How much appetite is there from the various parties to actually do so?
Well, Avril, I think that's a really good question right now. Donald Trump is saying that Zelensky wants to meet and that Putin wants to meet. Right? Zelensky at the White House was saying he would be happy to do so. He would be happy for Donald Trump to be there in a following trilateral meeting. So the words are being said. How this necessarily comes together, what preconditions there are, where this may take place, there are a lot of trip hazards in the way. I think where this takes place is a really interesting one that we're looking at right now. Vladimir Putin mentioned when he and Trump were meeting in Alaska that maybe the next time they could go to Moscow. For many obvious reasons, Ukraine probably does not want to send Vladimir Zelensky to Moscow. Another option that was mooted was the idea of Budapest. Now, Budapest, now Hungary, is one of the key nations that has been kind of blocking Ukraine's idea of getting into the European Union. And there are a bunch of historical reasons why Ukraine might not be thrilled with the idea of Budapest. So trying to figure out where is an acceptable meeting location is like number one on the agenda, and then everything else is harder from there.
It almost sounds like there are no good options here. Derek, thank you so much. Bloomberg senior editor Derek Wallbank. Some other stories we're following. U.S. Commerce Secretary Howard Lutnick says written documentation on the trade deals agreed to with Japan and South Korea are weeks away. He also told CNBC that Washington is on the same page as Tokyo and Seoul on the deals. Trump earlier announced that the U.S. would charge a 15% tariff on imports from both countries. The Trump administration says it'll step up scrutiny of imports of steel, copper, lithium, and other materials from China. It's seeking to enforce a U.S. ban on goods allegedly made with forced labor in the Xinjiang region. Under a 2021 law, the U.S. assumes anything made even partially in Xinjiang is produced with forced labor. But companies may win exemptions if they can present evidence that proves otherwise. President Trump has expanded the scope of his steel and aluminium tariffs to include more than 400 types of consumer items containing the metals. The updated list covers auto parts, chemicals, and furniture components, affecting products such as tableware and motorcycles. The change took effect on Monday and did not exempt goods already in transit, catching the logistics industry off guard. Shery.
And April, President Trump's tariff seems to be creating some strange bedfellows. Indian Prime Minister Narendra Modi hailing closer ties with China as Foreign Minister Wang Yi wrapped up a two-day visit amid Trump's tariff threats. The two sides confirming that Modi will meet with President Xi Jinping later this month in China. Chief North Asia correspondent Stephen Engel joins us now in Hong Kong. And Steve, it seems that New Delhi is recalibrating its foreign policy. How significant is this?
Yeah, it's pretty significant, but not to be unexpected because, again, the last time the Shanghai Cooperative Organization, or SCO, which is going to be meeting, by the way, the week after next or the weekend after next, is sent in China, and that's where Modi's going to go and meet Xi Jinping. The last time it met in Russia in, I believe it was October of last year, that's when Xi and Modi previously met just before the election of Donald Trump. But you could sort of see if you want to call it, the storm clouds of protectionism rising. And so for India and China, the world's two most populous nations and, sizable economies in their own right, as well as participants of the BRICS grouping, as well as the SCO, they are trying to sort of bridge their differences, join forces, and counter those threats of tariffs, because the Trump administration is threatening very soon upwards of 50% tariffs on India, 25% reciprocal tariff, plus an additional secondary tariff of 25% for India continuing to buy Russian oil in defiance of global sanctions. So they are making good on their pledges to improve their relations from that Kazan meeting in October of last year. So that's going to lead potentially to this summit on the sidelines of the SCO in Tianjin for the SCO on August 31st and September 1st. But again, the wild card is China also has very strong ties to India's longtime enemy, if you want to call it that, Pakistan. Wang Yi, by the way, leaves New Delhi today, goes to Pakistan for a couple of days as well. So yes, there's a massive global chess match going on right now.
And Steve, you give us a good reminder of how India could still see 50% tariffs. We're hearing from the U.S. Treasury Secretary Scott Bessent. He's reiterating Trump's justification to impose tariffs of these levels on India. What's his latest take on this?
Yeah, that's right. So he's essentially saying that India, before Russia's 2022 invasion of Ukraine, bought about 1% of its oil needs from Russia. Now he's claiming it's 42%. What he's saying, because of the price caps and the like on Russian oil, Indian conglomerates, for example, Mukesh Ambani's Reliance Industries, which has the world's biggest refinery in Western India, and they have been buying Russian oil. He's saying these Indian conglomerates have been buying cheap Russian oil and reselling it, and therefore profiteering. So if they have now 42% compared to 1%, there's an obvious reason why they're doing that. He's saying, Bessent is saying in an interview, I believe with CNBC, essentially that these conglomerates in India are profiteering up to the tune of $16 billion. So that is one of the justifications for adding this additional secondary tariff, according to the United States. This is something to watch going forward. India has repeatedly said, those additional tariffs are unfounded or unjustified, essentially that India can go to the global market and find the cheapest source of crude.
Right. Stephen Engel, our chief North Asia correspondent there. We have more ahead on the Asia trade. This is Bloomberg. Take a look at how U.S. futures are trading at the moment. Of course, we had a tech sell-off in the overnight session. We're still a little bit under pressure. This after we saw really the Nasdaq 100 losing ground. It's already at stretch valuations, trading at 27 times expected profits. In fact, options traders fearing a deeper tech plunge and now buying disaster puts. We're also following some idiosyncratic stories, so do watch out for Intel jumping after Secretary Lutnick confirmed that talks are on the way for the U.S. to take a stake. And of course, we have heard about that cash infusion from SoftBank as well. The Bloomberg U.S. dollar really not doing much. We had seen a little bit of gains in the overnight session, but really thin volumes overall. Treasuries also gained ground in the overnight session, but a lot of tight trading at the moment ahead of Jackson Hole, of course, and that Fed chair speech on Friday. We have more ahead on the Asia trade. This is Bloomberg.
The president has spoken this, and both leaders have expressed a willingness to sit down with each other. And so our national security team will help both countries do that. Ultimately, the president has always said that there are areas of disagreement in this war that will have to be discussed and decided upon by these two countries. And so he wants these two countries to engage in direct diplomacy.
White House Press Secretary Caroline Leavitt on President Trump's push for a meeting between Vladimir Putin and Ukraine's leader Volodymyr Zelensky. Let's get more on these diplomatic dealings behind the Russia-Ukraine conflict. Joining us now is Kristine Berzina, Senior Fellow for U.S. Defense and Transatlantic Security at German Marshall Fund for the U.S. Kristine, really good to have you with us. First off, let's start with what we're seeing from the meeting in Washington. European leaders seem to be rushing to capitalize on Trump's support while they can. What is your sense of how much they can count on it? How consistent is U.S. support going to be?
We've seen a lot of really interesting developments on U.S. security guarantees and support for Ukraine in the last couple of weeks. Since the beginning of this term and this war, Trump has said it is not his war. And so he's tried to create distance between himself and Ukraine's fight. And yet, in the last week and in the last days, we're seeing Trump express greater interest in helping provide security guarantees to Ukraine once the war is over. The Europeans have been putting together something called the Coalition of the Willing, which is a group of European countries, and not only European, that are interested in providing support once the war is over to maintain peace once it gets there. And there is the talk of boots on the ground. In particular, the Brits and the French are the most likely to be providing this, although even the Estonian prime minister today said that there was interest from Estonia in contributing. Now, this is an effort that hasn't had a U.S. military component, and it hasn't gotten very far because the U.S. hasn't said that it wanted in. And yet now we have a situation in which Trump is saying the U.S. can coordinate, the U.S. can be part. We're not talking about group boots on the ground at the moment, but we are looking at the potential to support from the air. Could mean airplanes, could mean intel, satellite, space. We don't know exactly yet, but the U.S. role here, in particular, if it was actual planes in the air, would be a game changer that would allow European countries to feel much more comfortable in sending their troops once a peace deal has been reached. This is notable, but I don't think there's a reason to think it's not serious on behalf of Trump. He has had very tough words for Ukraine, for Europe over the past few years and the past few months. And yet we've seen Trump commit significantly to Article 5, to the Europeans. He's been happy with the trade deal he has with the EU. He's happy with NATO defense spending. And now he's stepping up militarily, potentially here too. And that's excellent.
Which seems to suggest that this U.S. support could last. We also hear how he's advocating, Trump, for a Putin Zelenskiy meeting. What is your sense of how likely this is going to be?
This is going to be a very significant challenge. Trump knows, and the Europeans know, that we're not going to get anywhere unless we have an agreement between Putin and Zelensky. Putin hasn't wanted to be in one room with Zelensky. He is happy to have a bilateral meeting with Trump in Alaska. He feels very much himself to be a great world leader. And yet he doesn't seem to think that Ukraine should even exist as a country. So sitting down with what he thinks is the illegitimate president of Ukraine, of a country that he doesn't find legitimate at all, is in some ways, from Putin's perspective, beneath him. And so you need to come to a meeting between these two men when one man doesn't think that the other man is worthy of his time. And that's going to be incredibly difficult. Putin's going to have to come to terms with the fact that he has not been militarily able to take all of Ukraine. And Zelensky is going to have to sit at a table with the aggressor.
And President Trump urging that flexibility coming from both leaders, right? So what are some of the conditions that perhaps both leaders could live with at this point?
I think a key question here is what happens to the territory that has been occupied. Russia started 11 years ago with its aggression towards Ukraine, with capturing Crimea and areas of the Donbass, and it has only accelerated since then. Does that territory stay in Russian hands? It's very likely that de facto what is in Russian hands will stay in Russian hands because Ukraine has not been able to get it back. And then there's the question of what happens to that territory that Russia wants. So it has said that, or claimed to have annexed legally, these 4 regions of Ukraine. It does not hold the full regions of any of the 4 militarily at the moment. Putin would like, through diplomatic channels, to get what he couldn't get militarily. So these are the really tough spots at this question of territory,
Right.
and also the question of, is it de facto or is it legally recognized as Russian?
And once you get an agreement, that really sets precedent, right? Are there any red lines for the Europeans?
All of this is terrible in terms of precedent. The only good scenario in terms of European security, but more broadly for the international order that we have been living in, is that it is utterly unacceptable and will not work to change borders by force. It's important as a deterrent for any big country not to change the borders or invade its smaller neighbors. So if any of this territory stays in Russian hands, and it's incredibly likely that it will, this is a lesson for other major powers in the world that covet their neighbors' land, that if they start a war, it might be really hard, but at the end of the day, the map might be different. The Europeans don't love that, and there is a sense that the costs on Putin must be high so that he doesn't try this again. It's a question about, when will Russia have enough? Does it ever have enough? And what will other major powers around the world that might be inclined to be aggressive do to their democratic neighbors?
Right, the Europeans would be wary of rewarding aggression. Kristine, thank you for your analysis. Good to chat with you. Kristine Berzina is Senior Fellow for U.S. Defense and Transatlantic Security at German Marshall Fund for the U.S. Coming up, New Zealand Central Bank expected to cut interest rates by 25 basis points today and resume its easing cycle. A preview of that decision next. This is Bloomberg. Let's take a look at G10 bonds as the countdown continues towards Jackson Hole. Treasuries managed to snap a 3-session losing streak. They could still come under some pressure, though, and we are also seeing that pressure sort of affecting UK bonds, yields hitting their highest in nearly 3 months. And this is against the backdrop of inflation data that could come and cement the case against further easing from the Bank of England. We are also keeping watch on JGBs in the session after a poor showing for the 20-year auction just a day ago, and that really highlights the lingering political uncertainty and what that means for the fiscal trajectory of Japan. Of course, keeping tabs on bonds in New Zealand as well, as the RBNZ is seen cutting interest rates later today, restarting its easing cycle after a pause in July. The move comes amid growing signs of an economic slowdown. For more, let's bring in Bloomberg Economics Australia and New Zealand economist James McIntyre. So, James, more or less consensus, 25 basis points today, a cut from the RBNZ, but what next?
Yeah, thanks. So that's right. A cut again from the RBNZ today after that pause in July. It does look that we have seen the RBNZ, after delivering 225 basis points of rate cuts so far, that we're moving into a different phase of their easing cycle, a much more drawn out and slower phase. So our view is that they've still got a few more to go, but that those will be quarterly and that we're likely to see those pauses that we saw in July between each of the key quarterly meetings coming through. But it's going to be quite interesting what the RBNZ tells us today. They have previously in the May decision outlined an expectation that they could take their cash rate to slightly below neutral, but we have seen the economy continuing to struggle. it's likely that we might see them reaffirm that rates have further to go, and maybe a little bit further into neutral territory could be something that we're on the lookout for in their forecasts.
Tell us a little bit more about that economic data, because when it comes to inflation, it seems to be broadly in line with the RBNZ is thinking about, but is it all to do with the tariff threats and just global demand?
Yeah, so what we've seen when it comes to the inflation or the data that's come through since we had not only the July meeting, but since May, but especially over the last couple of weeks, the inflation indicators. So there's some monthly data that comes out, and that's shown a few little hot points in the inflation basket. Things like food prices ticking up. But we know that when we break that down, that's a story that's also benefiting New Zealand's economy from an income and a trade side. So whilst there's the US has announced that New Zealand's tariffs will go from 10% to 15%. On the other hand, the surge in dairy prices and in meat prices is giving an overwhelming export boost that's going to more than compensate for that. But unfortunately, that comes with a bit of a kicker in the tail, that those global produce prices, dairy prices are feeding through into some inflation pressures. That's not something the RBNZ's really going to be able to do anything to push back against or control. And at the same time, when we do look at things and we look at the domestic economy, confidence not so hot, especially for consumers, and the labour market looks like, instead of having a turnaround, which the RBNZ, which was how the RBNZ saw things in May, that it's continued to get worse and worse and worse. And so there's a little bit of work there that, even with maybe some bubbling inflation pressures, global inflation pressures still lingering a bit, that labour market is going to be something, that data there is enough, we think, to drag them over the line, not just today, but over the course of the coming months again.
Yeah, James, I was just about to ask you if we could just pick up on that point on what you're seeing in the labour market. The RBNZ could focus on it. What do you think we're going to hear, perhaps post-decision as well?
So when it comes to the last big discussion on the labour market, the May forecast, the RBNZ had said that they thought that the labour market was levelling out and about to begin an upswing, a cyclical recovery. Unfortunately, that's just not how it's turned out. We do get weekly data on the number of people receiving payrolls in New Zealand, which the tax department provides through to the Stats Bureau. That's showing that there's less people employed today than 2 years ago in New Zealand. And the monthly data that the RBNZ was relying on, that's been revised away. So that stabilisation and early nascent signs of an upswing is showing that actually things are going in the other direction on the labour market. So that's something that the RBNZ is going to have to come to terms with and acknowledge that. And when they do, I think it means they're going to be calling for that cash rate to be going a little bit further below neutral next year.
Bloomberg's James McIntyre there with what to expect from the RBNZ. Of course, we get that decision today. Staying with central banks, Federal Reserve Governor Michelle Bowman says she's staying focused on her regulatory portfolio, even as speculation grows over the succession plan for Fed chair. Bloomberg spoke exclusively with the vice chair for supervision ahead of this week's meetings at Jackson Hole.
Well, right now I'm committed to doing the job that I have, and we've really hit the ground running with our request for information on check fraud and other payments fraud, with the SLR proposal that we just put out, the LFI rating system. We're taking a really hard look at our supervisory components and across our reserve banks, as well as at the board, to ensure that we're focused on material financial risk. So I have a big agenda. We're moving through it quickly. Obviously, we need to get the capital proposals completed in the near future. But, you know, I'm really focused on the job that I'm doing, and I'm grateful to the President for appointing me and the Senate for confirming me to this role. So that's what I'm focused on right now.
Well, some Republicans on Capitol Hill have suggested that we should change this three-headed regulatory system and maybe take regulation away from the Fed. What are you telling them, and what do you think the odds of something like that happening are?
Well, I think the most important part is to remember that we have a banking system that's a dual banking system. So we have national banks and we have state chartered banks. And the FDIC and the Federal Reserve oversee those state chartered banks together with the state banking commissions. So I think it's important that we maintain the ability to oversee both the state chartered banks and the OCC with the national banks, and that we have a rational framework that is very similar for all of those banks going forward. So there's not arbitrage between the three regulators. But Congress is obviously responsible for making any changes to that system. So, we'll be working closely with them to ensure that they understand what we're focused on and what we're doing that's supportive of the efforts of all of the agencies together.
So you come out to Jackson, but you also go up to Capitol Hill a lot.
I spent some time on Capitol Hill, absolutely.
Fed Vice Chair for Supervision Michelle Bowman speaking exclusively with our colleague Michael Murty. Now it's also time for morning calls ahead of the Asia trading day, and Citadel Securities' Scott Rubner says retail investors may slow their pace of stock buying in September before picking up again later this year. In a note to clients, Rubner called the surge in equity purchases structural, not cyclical. He says it's driven by consumer health and market engagement rather than a passing trend, Shery.
And Avril, Bank of America is advising clients to sell 20-year Japanese government bonds, citing rising political risks. Strategists Oliver Levingston and Tomonobu Yamashita say expansionary fiscal policy is now inevitable after Japan's ruling coalition lost its majority in both houses. As a hedge, the bank recommends Australian dollar bonds, specifically a basket of the longest-dated Australian semi-government securities. In fact, we just had a weaker than average 20-year debt sale here in Japan, so we'll be watching JGBs at the open. This is Bloomberg. We have breaking news out of Japan. We are getting the latest trade numbers, and we're seeing the July export numbers, a contraction of 2.6%. And it's a really bigger contraction than what was estimated from the previous year. This could be the biggest fall in about 4 years or so. Of course, we continue to see the tariff pains deepening here in Japan, in fact, leading to a trade deficit of 117.5 billion yen. The estimate was still for a surplus, but we do have imports also falling 7.5%, a smaller contraction than was expected for the month of July. But this number also turning into a contraction from expansion in the previous month. We also have core machine orders coming out, a contraction or actually a gain of 3% for the month of June. The expectation was for a contraction. So perhaps the spending capex coming from these businesses not as bad as it was expected, especially after a contraction last month as well. So for June, we're seeing machine orders year-on-year growing 7.6%. But the tariff pain seems to be in place as, again, the export numbers for the month of July coming in at a contraction of 2.6%, bigger than expected. Given this backdrop, we're seeing conservative guidance by Japanese companies, leaving an opening for upward revisions perhaps in the next earnings season, which may further boost the market's record-breaking rally. For more, stocks reporter Momoka Yokoyama joins us now. So, Momoka, I mean, it's not necessarily surprising that Japanese companies give a conservative guidance, but what is prompting this more cautious stance now?
That's definitely true that Japanese companies have been traditionally sort of posting conservative, sort of cautious outlook for earnings. But this year, just about 61 topics included companies have revised up their profit guidance for the fiscal year through March. And that's about half of the ratio in the same period last year, and also the lowest percentage since 2020, when obviously the level of uncertainty was quite high with coronavirus going on. But obviously, the tariffs, although Japan sort of have settled at 15%, which is down from the originally planned percentage, until it reached that deal, there was so much confusion about how much of a progress has been made. And even after it reached a deal, the details to which was discussed or confirmed has sort of remained unknown and uncertain for some period of time. So I guess that has made companies to make it increasingly difficult and challenging to forecast what the profit or sales will look like towards the year end. Yeah.
Momoka, Avril in Singapore here. What is all this going to mean for Japan's Nikkei after it's rallied to its record high?
The cautious and conservative outlook might point for positive supplies, the possible positive supplies going forward. That's especially given the yen is trading sort of weaker than a lot of companies forecasted. Amongst TOPIX 500 companies, the assumption was around 144 per yen. 144 yen per dollar. And then now the yen is trading around 147. So that might give a buffer for the companies to sort of post surprisingly better outlook for the companies. And obviously with tariffs, we have a lot more clarity now with the 50%. So the companies might revise up or post better than expected quarterly earnings soon.
Right. Momoka, thank you so much. Bloomberg's Momoka Yokoyama for us. Checking some of the stocks to watch when trade opens in Australia, Korea, and Japan shortly as well. Asian tech will certainly be in focus after Nvidia-Led the Nasdaq 100 to its second worst drop since April's tariff shock, potentially pressuring the likes of SK Hynix and Tokyo Electron. Meanwhile, SoftBank's $47 billion AI-led rally is at risk of stalling, with the 14-day RSI now signaling that the stock might be overbought, Shery.
Yeah, so definitely the tech sector, really something to watch at the open. But of course, take a look at how we're setting up, because Nikkei futures are now pointing to the downside of 0.6%. This after already stocks fell from those record highs. The Japanese yen has been trading in a narrow range, all of this ahead of Jackson Hole, obviously. But we also had Japan's July export numbers surprising to the downside, a contraction of 2.6%, perhaps the steepest drop, I believe, in more than 4 years or so. So we'll keep you updated on what stocks to watch, especially when it comes to those exporters and export-focused stocks here in the country. Sydney futures, though, pointing to the upside of 0.2%. The market opens in Sydney, Seoul, and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens, and we're focusing, Avril, on monetary policy, because here in Asia, of course, we have the RBNZ expected to cut rates today, Bank Indonesia as well expected to stand pat, and central banks, of course, in focus ahead of Jackson Hole as well.
Absolutely. And we had Fed speak, right, from Michelle Bowman. We're going to be hearing as well from Christopher Waller. We also watching out for some of these data points out of the U.S. before we get to Jackson Hole, including jobless claims and some of these manufacturing PMIs. And all this against the backdrop of Trump really widening that dragnet on tariffs. It looks like he's targeting Chinese steel, lithium as well. And we're seeing potentially impacts on Asian economies as well from the tariff war.
Yeah, we'll be watching China's monetary policy as well, because we are getting those loan prime rates from commercial banks today. But take a look at the open in Japan, because we had seen already downside pressure for Japanese stocks falling from those record highs. And we can see the Nikkei now down 0.3%. We have those export numbers coming from July, a contraction of 2.6%, which was bigger than what markets had expected. The TOPIX is also down 0.1%, as we're still staying really range bound on the Japanese yen against the US dollar. This, of course, ahead of Fed Chair Powell Powell's speech later this week as well. We've been watching JGBs because the 20-year auction that we had just yesterday saw weaker than average demand, the 10-year yield at that 158 level. And take a look at how South Korea is also coming online because, of course, we mentioned those trade negotiations ongoing, the threat of more tariffs, but really we're hearing from Secretary Lutnick also saying that written documents when it comes to any trade deal with South Korea, with Japan, is still weeks away. The cost be down 1%. We had already seen the lowest levels in more than 2 weeks or so, and we're seeing that tech-heavy Kosdaq also losing 1.4%. That's the Korean won. It's still range-bound, April.
Yeah, let's take a look at what we're seeing in the rest of the Asia Pacific. As you said, the central bank is in focus. Today, we got the RBNZ. The Kiwi has been coming under slight pressure, but we have some of our strategists also saying that it could be biased higher if the U.S. rate trajectory is in focus. So as we watch out for Jackson Hole, keeping tabs on what we're seeing, Aussie against the greenback is looking pretty flat. The Australian stock benchmark is extending declines from a day ago. Remember, it was really that earnings digestion, including from some of these biotech names, CSL, that slumped by the most. I think it was on record that was the drag on the Australian ASX 200. So a bit of that extension into today's session. Seeing pressure creeping back into U.S. Treasuries as well at the start of trade. Now, of course, what we saw overnight was also that selling in tech stocks, Shery. And one stock that bucked the sell-off on Wall Street, interestingly, was Intel. Shares of the chip maker up nearly 30% this month so far. So let's get to our Asia Tech correspondent, Annabelle Jolas in Hong Kong. So, Belle, it looks like these Intel bulls, they're being rewarded for their patience finally.
Yeah, that's right. At long last, perhaps for some of those in the market. But I mean, the catalyst we've kind of been speaking about over the past few days. But just to recap those, there was the reports that the US government is looking at taking a 10% stake, an equity stake in the business. And as well, you had the plans for SoftBank to invest $2 billion into Intel as well. So off the back, I mean, you had a very strong session overnight, as you mentioned. But also, when you look what you've seen over the course of August, it's gains of around 30%. So it does mean that at this point, Intel is trading at a very expensive valuation. You're looking at 53 times projected profits over the coming 12 months. And that's the highest now going back to 2002. So it brings us into the dot-com bubble era, which of course is a bit of a cause for concern because Intel as a company, I mean, its outlook is highly challenged. We're just a few weeks off earnings, for instance, the latest release. It was still pretty grim, really, on the outlook. Lip Bhutan, the CEO there, has quite a big challenge ahead in terms of that multi-year, what could be a multi-year restructuring effort. And again, what analysts say as well, because fewer than 8% of the analysts that are tracked by Bloomberg have a buy rating on the stock. The vast majority, around 80%, keep a neutral rating instead. But certainly that valuation, again, has been one to watch. You're just looking at some of those big Asia suppliers here listed in Japan and Korea this morning. Mixed fortunes so far.
We've seen really huge gains for the broader tech sector on those optimism over artificial intelligence. We're seeing perhaps some changes in Meta's approach to its AI division.
Yeah, well, Meta, as you know, has really been pursuing artificial superintelligence. So it's a very ambitious effort, given we're not at general intelligence just yet. But they are looking at superintelligence. And to that end, they've been spending billions and billions of dollars of recruiting some of the top talent. It's now under the leadership of Alexander Wang. He's someone who recently joined the business in a formal capacity as the chief AI officer. And overnight, he sent out a memo to staff saying that they're going to be splitting the AI group into 4 different key divisions. So the first one will be overseeing Meta's large language models. The second one will be the existing internal AI research lab that's been around for about a decade, but it will be focused on longer-term projects. The third one will be looking at taking those models, that research, putting it into consumer products. And then the fourth as well will be looking at the expensive infrastructure that's needed to support Meta's AI ambitions. So no layoffs were announced, but it is just sort of making changes here, or that's at least according to sources familiar with the matter. But it is about sort of trying to capitalize on the amount of talent that has been hired into the business.
Belle, as we look to these U.S. giants' AI plans, it's also about Chinese names, Baidu's AI efforts. That's going to be a focus when it reports later. What are we expecting?
Yeah, that's right. I mean, we're kind of halfway through the reporting for the big 8 tech in China. Baidu is going to be one to watch, of course, closely later today. It's had quite a challenged outlook when it comes to AI. As we were saying earlier, it's a company that was an earlier front runner in the AI race in China. It was one of the first to get a large language model Ernie bot onto the market. But since then, it's really had to cede a lot of ground and it's faced a lot of really stiff competition. So our Bloomberg intelligence team is saying that revenue is likely to slip. In fact, net income or adjusted net income could have declined around 30% in the period. Couple of key concerns here. You've got the AI ventures. They're saying that those are going to be losing money for the next 3 years. The rising development costs of those as well are playing into it. Plus, you've got the ad revenue. Baidu, of course, it is the largest search engine or primary search engine in China. Ad revenue has been a primary revenue generator for the business, but as you build out AI, just like we see with other search engines in the US, for instance, there's always that concern that you're going to be cannibalizing your search business. And then as well, one last thing to watch in the earnings today will be the update on how the rollout of Apollo Go, that's a robo-taxi plan, how that's also faring, given that could be one of the brighter spots for the business.
Annabelle Drillers there with the biggest tech stories today, and take a look at how we're setting up with those tech names across Asia. A little bit of a mixed picture right now as you see Samsung gaining ground, but SK Hynix on the other hand losing more than 2% at the moment. Of course, we've talked about the tech sell-off in the overnight session, stretched valuations, the Nasdaq 100 trading at 27 times expected profits in the next 12 months. Now we're seeing options traders fearing that deeper tech plunge, buying disaster puts, and you can see SoftBank really unchanged and not trading as of yet after we heard about that potential $2 billion investment into Intel, Avril.
Yeah, tech, as you alluded to, is really front and center today after it led the selling on Wall Street overnight. What is this going to mean for Asia stocks? Let's bring in our next guest who remains bullish on Asia equities for the rest of the year. With us now is Rupal Agarwal, Director and Senior Research Analyst at Bernstein. Rupal, really good to have you with us. Just starting off from the backdrop first of what we're seeing in the U.S. Is this healthy rotation or a sign of something more concerning?
Hi, good morning. So I think what we've seen overnight coming from U.S., it's just a sign that a lot of the markets are priced for perfection. And hence, this is a healthy correction in our view. Nothing, in terms of what surprises us. While we have remained more bullish for the broader Asian markets, there were expectations that in the near term, markets are likely to remain volatile because there is still a lot of geopolitical and tariff uncertainty. And hence, our recommendation for investors have been that, it's just too soon to not have hedges. And that hence, we do think that some of this recent volatility was expected.
What is your sense of the risk of a reversal and which Asia markets are more exposed?
We think across Asian markets, there are certain types of stocks which are at very high risk of a reversal. I would attribute it to the fact that across Asia, there's been a very strong valuation-driven cycle, and the earnings has been not coming through across the board. And hence, there has been a strong chasing of, limited number of stocks where the earnings momentum has been very strong. You can see that across markets, whether it's, market like Korea, which has been phenomenal this year, market like China, which has been very resilient, even market like India, where it's been struggling a bit, but, stocks where the earnings momentum has been very strong, has actually reached a point where across markets it's looking or trading at record valuation. So that is where we do believe there is a high risk of reversal.
How does the Chinese market stack up there? Because there was a lot of optimism over the tech sector earlier this year with the frenzy around DeepSeek. Where are we now, especially perhaps for those high growth stocks?
Again, we are making a call that, while the growth stocks in China have done phenomenally well, I don't think there is an imminent risk of a reversal. But as we progress through the year, some of these stocks are likely to start seeing some downward pressure because what we have seen in China is this trend and this extreme dispersion where the kind of momentum that we've seen in growth stocks is at 20-year high. And hence, we do think that they are at a higher risk of a potential inflection sometime later in the year. So not an imminent one, but something to really watch out for.
Could we see an inflection in the Japanese markets? I mean, we have been around record highs, but at the same time, when we got the export numbers today, they look pretty grim, especially given the tariff hit.
Absolutely. I think Japan in the recent few months have come back quite sharply. But again, similar to our positioning across Asia, the thought process was that it's just too soon to not have hedges, and hence we are still sticking to a bit of defensive exposure even in Japan, while adding more cyclicality as we go, through the year. So there is, while the rate hike cycle, for example, is back on the table, we still think that, there is a lot of macro uncertainty, geopolitical uncertainty, and hence in the near term, there is a need to hide into some of the quality names in Japan.
In the near term, are you putting any hedges, or are you being a little bit more concerned given that we're headed to Jackson Hole, and what will you be focused on?
So I think Jackson Hole is extremely important this time around. We need to understand, whether we are heading towards an aggressive rate cut environment. That's probably one big boost, which is remaining for the broader markets. But I would also say that, the focus needs to come back on the fundamentals. There are markets in Asia where the rally has been much more driven by valuations, in some instances purely currency, for example, Taiwan. And that is where, I'm a bit concerned. So the way that we are approaching the rest of the year is incrementally we keep on getting more bullish. We add more, we basically remain, dip buyers in certain markets like, say, China, Japan, India. But we need to be more selective in terms of, adding more cyclicality too aggressively.
Rupal, to your point on adding on China, we've also been seeing mainland turnover really picking up. I mean, how important are you seeing that as a driving force of sorts?
Well, it's been one of the biggest driving force in our view. If we look at the global flow towards China, that's been relatively weak, except for the very sharp inflow that we saw back in February after the DeepSeek moment. Largely, Chinese equities have been driven by domestic money, and we still think that there's a long way or a long tail to that particular, support. At the same time, it does raise a question in terms of how further we have come through the rally. There are certain early signs, I would say, across the market where there are too many stocks which are already, looking reasonably expensive. And hence something to really just be watching out for. While there is a lot of optimism on continuity of the domestic flow, we are heading towards a potential, reversal, not, as I said, not an imminent one, but something to just, be aware of.
Rupal Agarwal, really good to have you with us, Senior Research Analyst at Bernstein. We have more ahead on the Asia trade. This is Bloomberg. President Trump is urging Russia's Vladimir Putin and Ukraine's Volodymyr Zelenskiy to show flexibility as the White House encourages the two leaders to hold a bilateral summit.
The president has spoken to both leaders about this, and both leaders have expressed a willingness to sit down with each other. And so our national security team will help both countries do that. Ultimately, the president has always said that there are areas of disagreement in this war that will have to be discussed and decided upon by these two countries. And so he wants these two countries to engage in direct diplomacy.
Let's bring in Bloomberg senior editor Derek Wallbank with us. And Derek, so do we have any idea right now what security guarantees could look like for Ukraine?
Well, Shery, this is all very much in development, so there's not a lot of meat on the bones here. But what you're seeing is a concerted effort from European partners in the so-called coalition of the willing to try and form a security apparatus that could present a credible deterrent to Russia in favor of Ukraine in any sort of peace scenario. Trump was open about the idea that he was okay with this sort of multinational force that could be there, an Article 5 style trigger. This wouldn't be NATO, but kind of modeled on that Article 5 style trigger. There, again, a lot of ideas circling around, not anything specific, although we do have an idea that American military equipment would probably be a key part of this, purchases certainly, but probably not American boots on the ground. That would probably be European boots on the ground sort of trying to do that. Now, the European partners are trying to do this a little bit because they see that it's not something that they want Vladimir Putin to have a veto over. You know, this is something that Putin, in their view, probably doesn't want to have happen. But since Trump is open to it, since they were just at the White House, the idea is go now, get this set up, make this a little bit of an inevitability, and it sort of strengthens Ukraine's position going forward.
How much momentum is there for this to carry on into a Putin Zelenskiy meeting, which is what Trump wants to see, and not just that, he thinks it's better that the two meet without him?
Well, that's right, Agarwal. You know, when we were hearing from Trump in Alaska, he was talking about a trilateral as the next stage. And then after meeting Zelensky, you know, the next time that we heard from Trump, it was, oh, we'll do a bilateral between Putin and Zelensky, and then it will be a trilateral if necessary that he would also go to. So that's kind of where we are right at the minute. Now, Zelensky and Putin, to some degree over the last several months, have been sort of playing this kind of contest of trying to make sure that the other person is seen as the unreasonable one, as the obstacle to a peace process. Trump has said that he thinks both of these folks are credible actors looking for peace, but he's also said that both will have to make sacrifices of some kind. For Ukraine, that is a clear nod to the idea of territorial concessions. Both the 2014 claim on Crimea, which Russia took over at that point, as well as some lands that Russia has taken since 2022. What Russia might concede, it's a little bit harder to say. You know, Zelensky has talked about prisoner swaps. He's talked about people who are taken from Ukraine being repatriated, other things like that. But any sort of deal is likely to fall very far short of the original Ukrainian aims, which were some form of consequences for Putin, all of the territory that was lost coming back, reparations of some kind, etc. Now, Ukraine does, it is important to note, have some other things that it very much wants in terms of overall stability. One of those is a path into the European Union, and we understand that Trump called Viktor Orban, the Hungarian leader, who has been one of the stumbling blocks to that idea, to try and sort of suss out whether any movement on that was possible. It does not seem so far like Orban has moved on that point, but certainly if you're talking about a durable peace process, something that doesn't get us back to this point in 3, 4, 5 years, one of the questions you're asking yourself is what sort of structural guarantees could Ukraine get? Trump is not keen on Ukraine joining NATO, but the European Union, maybe that's something that is seen as a deterrent because maybe, you know, Putin wouldn't want to invade an actual UN member nation. There's a lot that's going on here in the sidelines in terms of trying to craft something. There are a ton of unanswered questions here, but this is kind of where the conversation is framing as we look forward to a meeting that so far is suggested, but very much is not firmly on the calendar yet.
Derek, thank you so much. Bloomberg senior editor Derek Wallbank. Now, as Derek was just alluding to, European leaders are really rushing to capitalize, leverage on the support that they've gotten for Trump so far in shaping some of these contours of Ukraine's security guarantees. And against this backdrop, let's take a look at how Euro Stoxx 50 futures are faring at the start of trade, down 0.5%, looking quite negative at the moment. The euro against the greenback is also losing ground. The other currency or cross that we've been keeping tabs on, the British pound, of course, this is ahead of inflation data that could cement the idea that we might not see a BOE that's cutting yet again. Shery.
Right, Avril, and some of the other stories that we're following at the moment, U.S. Commerce Secretary Howard Lutnick saying that written documentation on the trade deals agreed with Japan and South Korea are weeks away. He also told CNBC that Washington is on the same page as Tokyo and Seoul on the deals. Trump earlier announced that the U.S. would charge a 15% tariff on imports from both countries. The Trump administration says it will step up scrutiny of imports of steel, copper, lithium, and other materials from China. It's seeking to enforce a U.S. ban on goods allegedly made with forced labor in the Xinjiang region. Under a 2021 law, the U.S. assumes anything made even partially in Xinjiang is produced with forced labor. But companies may win exemptions if they can present evidence that proves otherwise. President Trump has expanded the scope of his steel and aluminum tariffs to include more than 400 types of consumer items containing the metals. The updated list covers auto parts, chemicals, and furniture components, affecting products such as tableware and motorcycles. The change took effect on Monday and did not exempt goods already in transit, catching the logistics industry off guard. We have more ahead on the Asia trade. This is Bloomberg. We're watching SoftBank right now. Of course, we continue to see the losses of more than 8% despite the $47 billion stock rally that we saw this month, really hitting the wall. Aggressive investments in artificial intelligence. We heard of those plans to invest $2 billion in Intel, but we're seeing some profit taking. The 14-day RSI in overbought territory, not to mention that the price is already much higher than most analysts' target prices. So we're seeing that downside right now, Avril, on SoftBank.
Yeah, the other big asset class we're watching, of course, is bonds, not just in Japan, but in New Zealand, seeing some pressure at the moment. And this is despite the expectations that the RBNZ is going to cut 25 basis points. That pressure also seems to be coming through on the Kiwi against the greenback. This is Bloomberg.
We're seeing broad downside across markets in Asia, with the Kospi losing more than 1%, almost 2% right there. We're at the lowest levels since early July already. The Nikkei is also extending those losses that we saw in the previous session, and all, of course, to do with perhaps a little bit more risk-off sentiment ahead of Jackson Hole. We've been watching also trade numbers. Japan's July exports disappointing to the downside, trade surplus turning into trade deficit. In fact, we heard from the Secretary of Commerce, Lutnick, talking about written documentation on the trade deals agreed with Japan and South Korea still being some weeks away. And it's really President Trump's tariffs that perhaps is also leading to some geopolitical realignment. Indian Prime Minister Narendra Modi hailing closer ties with China's Foreign Minister Wang Yi wrapped up a two-day visit. The two sides confirming that Modi will meet with President Xi Jinping later this month in China. Let's get more with Pradeep Taneja, senior lecturer in Asian politics at the University of Melbourne. Really good to have you with us. Are we looking right now at New Delhi really repositioning its foreign policy? And what happens to Washington's Indo-Pacific strategy now?
Well, that's a good question. The relationship between the U.S. and India lately has been perhaps the worst it has been in the last 20 years. And Foreign Minister Wang Yi's visit to India obviously is part of a border discussions between India and China. They have a mechanism called the senior representatives meeting, and they represent their individual leaders. But the timing couldn't have been better from India's point of view, because it sends a clear signal that India has options, that India is improving relations with its neighbor, China. India already has a good relationship with Russia. So, the signaling could be, or it's indirect signaling from India to the US that we do have other options. But having said that, I think it's important to remember that US-India relationship is very important. Both countries have invested heavily over the last 20 years in this relationship. There's a lot of political capital that's gone into building up this relationship. So India is not about to sacrifice its relationship with the US, but clearly, given President Trump's language, he called the Indian economy a dead economy, which was obviously very offensive from India's point of view. And Indian government is trying to signal to the US that we believe in multipolarity, we have a policy of strategic autonomy, and we will improve our relations with China if we have to.
So if we're perhaps seeing this pause in the warm relationship between the U.S. and India, at least with the Trump administration now in power, what does that mean for other groupings and alternative friends that you talk about? Because we also heard from Prime Minister Modi just this week calling President Putin again a friend.
Yeah, I mean, as I said, Prime Minister Modi is not going to do anything that would jeopardize the relationship with the United States. President Trump is in office for another 3 years and a bit, but the US-India relationship is far more important than any individual. So Prime Minister Modi is not going to go into name calling or calling the American economy a dead economy to retaliate, but he is going to try and do everything possible to improve the relationship with the US. Remember, the US market is very important for Indian companies, and India doesn't want to do anything to jeopardize that relationship.
Pradeep, I wonder, though, what could potentially scupper what we're seeing between India and China? How big is an issue of Pakistan?
Well, Pakistan is a very important factor. India, as you know, India and Pakistan engaged in 4 days of hostilities around the Jammu and Kashmir area, and also the fact that Foreign Minister Wang Yi, he is leaving this morning for Pakistan. The reports are saying that he's traveling from India to Pakistan. And that's not something that India likes, because India doesn't like to hyphenate itself with Pakistan. It sees itself as a better and a much more attractive country to work with than Pakistan. And India has in the past objected to India's interlocutors engaging with Pakistan at the same time as they engage with India. So this visit to Pakistan directly from India is certainly not going to go down very well in India.
With that in mind, would you say then that this symbolism between India and China, the signaling, the extent in which, your assessment of how this is actually going to translate into regional groupings, which is, I think, the point that Shery was alluding to, such as BRICS, challenging the U.S. and the U.S.-led global order?
Well, Indian diplomacy has always played on both sides of the road. India has over the last 20 years improved relations with the U.S., with the West more broadly, but at the same time, it continues to maintain very good relationship with Russia. It is a member of BRICS. It is also a member of the Shanghai Cooperation Organization. And therefore, it's part of India's policy of multipolarity and not having, not becoming a treaty ally of any one power. So India believes in strategic autonomy, and I think being able to engage with both the United States and the West more broadly, and with Russia and China through SCO, through BRICS, is part of India's foreign policy. So it does require fairly careful, very deft handling of Indian diplomacy, but Indian diplomats are pretty good at doing it because they've been doing it since independence.
And it seems the catalyst for all of this realignment recently has started with, of course, President Trump's tariffs and the threats of 50% tariffs on Indian goods. We do have that August 27th deadline when it comes to reaching an agreement. Do you think there are some low-hanging fruits, and what do you expect the outcome to be on a potential trade deal?
Well, before I comment on the tariff, and as you said correctly, They are supposed to come into effect on the 27th of August. The fact is that India and the Trump administration were engaged in very serious trade negotiations. India had made the most generous market access offer to the United States in India's history. And President Trump and the Trump administration have rejected that offer, or at least not accepted that offer. From India's point of view, that's a very big negative. But there is still hope that because President Trump is given to changing his mind, changing his position all the time, so it is still hope that India and the US would be able to reach some sort of understanding before the 27th, although I know it's very close now.
Amid all this, it's also about how the tariff threat is being received domestically in India. I mean, we saw just a couple of days ago Modi coming through with tax, potentially a new regime. We can see cuts as well. What is your sense of how this is being assessed by the Indian public?
Well, this is a good question because there was a very favorable, very positive mood, public mood towards the relations with the United States. And that mood has been soured by these announcement of 50% tariffs on India. So in terms of public opinion, I think the Indian public is with Prime Minister Modi. And in fact, the actions taken by the Trump administration make it much more difficult for Prime Minister Modi to make any further concessions to the United States.
Pradeep, really good to chat with you. Thank you so much for your analysis. Pradeep Taneja is Senior Lecturer in Asian Politics at the University of Melbourne. Now, we are also tracking EVs, and Tesla has priced its new 6-seater Model Y in China in the same range as local rivals, trying to win over middle-class families in the country's hyper-competitive market. Bloomberg's transport reporter Danny Lee joins us now from Hong Kong. Danny, we're looking at Tesla and how it's jostling against a local competition. What is your sense of managing to fight back against these local players from its pricing strategy?
Yeah, Tesla is trying to price to perfection in a really highly competitive marketplace. A marketplace of late, it has struggled with falling sales, greater competition than ever. But yes, indeed, this new 6-seater Model Y it released, or the pricing it released, rather, that's coming in similar to some of the local rivals, such as your Li Auto L8 and the Ito M8 as well. So these are all very competitive products, and the fact that Tesla has to come to a level where it needs to stay relevant in the marketplace. And so, yeah, this is indeed its shot to try and revive sales, not just in China, but more broadly globally. And so, indeed, what you have seen in its Shanghai factory, which is its largest in terms of output, it has struggled, and that has been a kind of indicator of its broad performance. But this it helps at a time where we are looking for other catalysts, and we are still waiting for the Chinese government to approve driver assistance features that Tesla wants to roll out into China, such as full self-driving. And so this could help really spur on this revival for Tesla, and to try and rein in some of that competition that it has been facing of late.
Yeah, I mean, it's become such a crowded market. It's been really interesting to see the latest developments in the EV space, especially with the likes of consumer tech giant like Xiaomi, for example. And we're now hearing about some global expansion plans for this company as well.
Yeah, I mean, Xiaomi having had a really strong run through its earnings and reflected through its emerging EV business. Now its next plan is to go to Europe by 2027, so taking on the likes of Tesla and BYD in a different marketplace. And it feels very confident, even with a small lineup, but a very popular set of products it's produced out of China at a very affordable price. So yeah, this is very much consistent with Xiaomi going global and making that $10 billion bet. But what we have seen, though, is Xiaomi's earnings. You've seen on the EV side, losses narrowed in the second quarter to 300 million yuan. Revenue hit in line with expectations largely. But it does come at a time when its core business unit of smartphones has been sluggish in terms of sales. So it's good on one hand that it is seeing some growth in somewhere like the EV business, which is really helping earnings. And, as it tries to look beyond, say, like smartphones and have a bit more of a diversified consumer portfolio, this is something that is one to watch as it tries to really push the boundaries with more products, not just phones, but into EVs as well.
Danny, also one to watch is Xpeng. While Xiaomi met, Xpeng missed the estimate for the revenue forecast. I mean, what are you gleaning from these results?
Well, Xpeng has had a strong recovery after finding difficult periods over multiple months in terms of sales. But, its sales of late have been really strong. And I guess the expectation for analysts was to see that strong performance in the volumes of sales into something like the kind of revenue expectation. Clearly, that has been shy of what the street is looking for. But then again, it is in a much better position with losses being cut significantly. So I think, generally speaking, given the more difficult regulatory backdrop, what China is trying to do to keep the competition in check, to ensure that there is less cutthroat competition, I think the likes of Xiaopeng being in a better position on earnings and on sales puts him in good stead, regardless of whether the street it's not meeting its expectations, particularly for the third quarter.
Bloomberg's Danny Lee there, and in fact, we'll hear more about Xpeng directly from the Vice Chairman and President Brian Gu about their earnings outlook, global expansion plans, Tesla's new pricing as well. That's coming up on the China Show at the Times on your screen. This is Bloomberg. It's hot, hot, hot here in Japan, and perhaps no relief in sight. Japan's National Weather Agency says high temperatures across much of the country are set to last for another month. The persistent heat is set to keep power demand elevated, with the lack of rainfall hitting hydropower generation. The key rice-producing regions of Tohoku and Hokuriku are getting less than half their usual rainfall, raising risks to the nation's staple grain at a time of growing public resentment over the cost of living here, April.
Yeah, Shery, and the other thing we've really been tracking is President Trump's trade deals, right, and their impact on Asian economies and how these higher tariffs on exports, especially the region's export-driven emerging markets. Bloomberg NEF, an energy transition and trade specialist Caroline Chua joins us to break down what these new agreements mean for the region. Caroline, what are we seeing in terms of the impact from these deals and the implications for clean tech exports from the region?
Yeah, so we've really seen the efforts of the governments here in the APEC region and their proactiveness in engaging the U.S. for trade negotiations really pay off. Several key APEC markets have successfully secured lower reciprocal tariffs than what was previously announced back in April this year. So key APEC markets are now facing a tariff range of between 15 to 40%, and that's down from the 17 to 49% that we heard back during Liberation Day. And among them are particularly big winners such as Cambodia and Vietnam that now faces tariff levels of 19 and 20% respectively, down from 49 and 46% that they were threatened with back in April. So there are some wins there. And in terms of the clean tech export side of things as well, Japan has secured through their trade deal a 15% tariffs on their vehicle exports. That includes electric vehicles going into the U.S., and that's lower than the standard 25% U.S. Tariff imports for vehicles going into the country. And so this will give Japanese automakers an edge around the world. But the story is less positive for other sectors such as solar and batteries, and these sectors remain under quite heavy scrutiny. Solar in particular is quite hit quite heavily, and the solar exports actually dominate exports from Southeast Asia into the U.S. And these exports are also subjected to other duties such as the anti-dumping and countervailing duties, which were introduced to try and level the playing field for local manufacturers in the U.S. So this have raised costs for exports going to the U.S. and have cut the flow into the U.S. quite significantly.
So when it comes to these clean tech exporters, are we seeing a change in their strategies given these latest developments?
Yeah, so we're seeing them being quite adaptable. In the past, APAC manufacturers have tried to shift their production bases around the regions across different Southeast Asian markets to where allows them to remain competitive and still access the U.S. as an important export destination. But as increased trade restrictions are being laid out, protectionism measures increase, they are actually facing quite a heavily constrained environment. It's getting very difficult to find safe havens around the world. And so in response, what we've seen them do is continue to seek out new production bases, such as in the Middle East, in North Africa, but also seek out demand from outside of the US in emerging markets where the adoption of clean energy is accelerating, just so they could continue selling their products and reduce their reliance on the US. There is an added layer of complexity in terms of strategy in the midst of all the trade policy developments, and that's the introduction of the transshipment rule that we saw in the latest announcements for the tariff levels. And the US is looking to impose a 40% tariff penalty on products that they deem to have been rerouted in order to avoid duties. And what that means is that it will affect strategies of how APAC manufacturers choose where they choose to produce, how they choose to deliver goods into the U.S. And the intention of this transshipment rule is to close out tariff circumvention loopholes. But the rules are still vague, and we are still pending clarification for what that really means, how they're going to determine if something has been transshipped. And in the short term, it actually potentially could create arbitrage opportunities. For example, a solar module that is manufactured in Cambodia and exported to the U.S. now face an effective tariff level of about 671%. But a panel that's made in China and determined to have been shipped through Cambodia into the U.S., pending further clarifications and announcements, face a tariff level of about 424%. So that's definitely going to affect how manufacturers choose to sell and where they choose to produce.
Right. Bloomberg NEF APAC Energy Transition and Trade Specialist Caroline Chua there. We have more ahead on the Asia trade. This is Bloomberg. All eyes on central banks this week ahead of Jackson Hole. Not to mention here in Asia, we do have a couple of central bank decisions, including the RBNZ, widely expected to resume cutting interest rates to 10-year yield holding at that 449 level. And of course, we do have Bank Indonesia as well, expected to stand pat in order to support the rupiah. We've been watching JGBs as well very closely because we have a 20-year debt sale having weaker than average demand. So we continue to see really the pressure on JGBs long term. It's really a global story, actually, when it comes to longer dated bonds under pressure globally because of some of those fiscal concerns. But of course, we're headed towards the speech by Federal Reserve Chair Powell on Friday as well, and what that means for that rate cut potentially coming in September. Fed Governor Michelle Bowman saying that she's really staying focused on her regulatory portfolio as well, even, of course, as speculation grows over the succession plan for Fed Chair. Bloomberg spoke exclusively with the Vice Chair for Supervision ahead of this week's meetings at Jackson Hole.
Well, right now I'm committed to doing the job that I have, and we've really hit the ground running with our request for information on check fraud and other payments fraud, with the SLR proposal that we just put out, the LFI rating system. We're taking a really hard look at our supervisory components and across our reserve banks as well as at the board to ensure that we're focused on material financial risk. So I have a big agenda. We're moving through it quickly. Obviously, we need to get the capital proposals completed in the near future. But, you know, I'm really focused on the job that I'm doing, and I'm grateful to the President for appointing me and the Senate for confirming me to this role. So that's what I'm focused on right now.
Well, some Republicans on Capitol Hill have suggested that we should change this three-headed regulatory system and maybe take regulation away from the Fed. what are you telling them, and what do you think the odds of something like that happening are?
Well, I think the most important part is to remember that we have a banking system that's a dual banking system. So we have national banks and we have state chartered banks. And the FDIC and the Federal Reserve oversee those state chartered banks together with the state banking commissions. So I think it's important that we maintain the ability to oversee both the state chartered banks and the OCC with the national banks, and that we have a rational framework that is very similar for all of those banks going forward. So there's not arbitrage between the three regulators. But Congress is obviously responsible for making any changes to that system. So, we'll be working closely with them to ensure that they understand what we're focused on and what we're doing that's supportive of the efforts of all of the agencies together.
So you come out to Jackson, but you also go up to Capitol Hill a lot.
I spent some time on Capitol Hill, absolutely.
Fed Vice Chair for Supervision Michelle Bowman speaking exclusively with our colleague Michael McKee. That's it from the Asia Trade. Our markets coverage continues. This is Bloomberg.